Tilray Brands is currently trading at approximately $1.39, a significant distance from the aspirational $10 mark that often circulates in investor forums and online discussions. The stock's 52-week range paints a clear picture of volatility, having swung from a low of $0.35 to a high of $1.88. This immediate snapshot, however, is a mere surface reading that fails to capture the intricate and often contradictory forces at play within the company and the broader cannabis industry. The popular narrative surrounding Tilray is a simple one. It's a bet on the long-awaited federal legalization of cannabis in the United States, a massive untapped market that would supposedly unlock explosive growth and send its share price soaring. The belief is that with its diversified portfolio and established international presence, Tilray is the best-positioned player to capitalize on this regulatory shift. But this expectation is fundamentally flawed, and a deeper analysis reveals a much more complex and, frankly, more precarious reality. The expectation of a U.S. legalization catalyst is the most potent but also the most misleading thesis for Tilray. While the potential for federal rescheduling is a significant macro-level development, the market has persistently overestimated its immediate impact. The reality is that even if cannabis is rescheduled from a Schedule I to a Schedule III drug, a move that would alleviate the crippling tax burden of IRS Section 280E for U.S. operators, it would not automatically open the floodgates for Tilray's Canadian products. Federal rescheduling primarily benefits companies already operating within the U.S. state legal framework. Tilray, as a Canadian entity, would still be restricted by a patchwork of state-level laws and would not be able to simply export its products across the border. The path to a U.S. market entry for a company like Tilray is not a single grand act of legislation, but a long, arduous process of navigating a state-by-state landscape, building new infrastructure, and acquiring existing licenses. This isn't a race, it's a marathon with a very uncertain finish line. Furthermore, the very existence of a massive, profitable black market and the challenges of consistent quality and pricing in a fragmented legal market present significant headwinds that a simple change in federal classification won't solve overnight. Now, let's pivot to the company's internal dynamics, an area where the tension between expectation and reality becomes even more pronounced. The common belief is that Tilray's aggressive acquisition strategy, which has seen it gobble up everything from craft breweries to wellness brands, is a brilliant diversification play that de-risks the company from the volatility of the cannabis sector. The logic is sound. If cannabis reform stalls, Tilray can lean on its robust beverage and wellness segments to generate revenue and eventually turn a profit. But the reality is that this strategy has not yet delivered the expected results. In its most recent fiscal reports, Tilray's beverage and wellness segments have shown growth, but they are not the runaway successes many hoped for. The Q3 2025 earnings report revealed a net loss of over $790 million, largely due to a massive non-cash impairment charge. While the company's gross profit and margins have shown some improvement, the persistent net losses raise serious questions about the long-term viability of its diversified portfolio. The acquisitions, while broadening its revenue streams, have also introduced new complexities and integration challenges, and the combined entity is still struggling to achieve sustained profitability. This isn't just a matter of scale, it's a question of whether the parts can ever truly create a profitable whole, a thesis that remains unproven. The narrative of Tilray as a safe, diversified bet in a risky sector is contradicted by the cold, hard numbers of its balance sheet. The true story of Tilray's potential and the reason for the extreme variance in its stock price lies not in its broad business segments, but in a very specific and often overlooked micro-level factor: its strategic repositioning within the global medical cannabis market. While the public narrative fixates on U.S. recreational legalization, Tilray has quietly but very intentionally been shifting its focus. For example, in the third quarter of fiscal year 2025, the company made a strategic decision to redirect its product from the saturated Canadian market to higher-margin international medical markets. This wasn't a temporary tactic, it was a fundamental reorientation of its business model. The result? The company's global medical business, which combines its international and Canadian operations, now accounts for approximately 80% of its total cannabis profits, despite contributing only about 35% of total cannabis sales. This is the most critical piece of the puzzle. It shows that Tilray isn't just waiting for a U.S. catalyst, it is actively pursuing a path to profitability by focusing on the most lucrative and least volatile segment of the market. This application of a clear, disciplined strategy to its core business, prioritizing margin over volume, is a powerful and differentiated insight that moves beyond the typical investment theses. It suggests that if Tilray can continue to expand its footprint in international medical markets, like Germany, which recently saw significant progress in its cannabis laws, it could establish a sustainable and profitable core business regardless of the pace of U.S. reform. The framing here is everything. Tilray's success may not be tied to the speculative, high-risk recreational market, but to the more stable and regulated medical one, a distinction that most analysts and investors miss. This is the real story, and it's far more compelling than a simple bet on legalization. The balance sheet itself presents another layer of complexity that challenges the popular narrative. The expectation is that Tilray is a financially distressed company, constantly teetering on the edge of dilution and burdened with debt. The reality, however, is that while it has had its struggles, the company has made significant strides in strengthening its financial position. In recent quarters, Tilray has reduced its outstanding debt, and its cash and marketable securities give it a measure of financial flexibility. But the narrative of financial health is still incomplete. The massive non-cash impairment charges, a direct consequence of a decline in market capitalization and other macroeconomic factors, reveal a deeper fragility. While a non-cash charge doesn't impact immediate cash flow, it reflects a fundamental reappraisal of the value of its past acquisitions and assets. This signals to the market that the company's growth by acquisition strategy may have come at a higher cost than initially perceived, and that the value of those assets is not what it once was. The framing here is that a strong balance sheet is not just about debt reduction, it's about the inherent value of the company's assets, and in that regard, Tilray faces a more significant challenge than many believe. Furthermore, the macro-level regulatory environment, which is often framed as a simple on-off switch for U.S. legalization, is in reality a complex and fragmented mosaic of policy changes. For Tilray, this means navigating a labyrinth of regulations not just in the U.S., but globally. Consider the European market, which is often cited as a key growth driver. While countries like Germany are moving forward with medical cannabis legalization, the process is slow and fraught with regulatory hurdles. The idea that Europe will be a seamless, high-growth market is a simplification. Each country has its own unique regulations, standards, and import requirements, and Tilray's success will depend on its ability to execute on a country-by-country basis. This micro-level execution is the real story, not the macro-level headlines about European legalization. The company's recent move to introduce new strains in Germany is an application of the strategy, but it's a small step in a very long journey. The framing here is critical. Tilray is not just a cannabis company, it's a global CPG company that must contend with an ever-changing and unpredictable international regulatory landscape. In conclusion, the journey for Tilray Brands Inc. is far more nuanced than a speculative bet on a single event. The popular expectation of a rapid, U.S.-led ascent to a $10 valuation is built on a misunderstanding of how the cannabis industry is actually evolving. The reality is a company that, while making important strategic moves, is still grappling with persistent unprofitability and the challenges of integrating a diverse portfolio of businesses. The deeper reality reveals that Tilray's most promising path forward is not a macro-level U.S. legalization event, but a micro-level, disciplined execution of its international medical cannabis strategy. The company's focus on high-margin markets, its ongoing debt reduction, and its strategic pivot away from low-margin categories in Canada are the true drivers of value. However, the legacy of its acquisition spree and the significant non-cash impairment charges demonstrate that the path is not without its deep-seated challenges. The narrative of a diversified, de-risked company is contrasted by the hard reality of a business still searching for a sustainable, profitable model. For investors to truly understand Tilray, they must look past the headline-grabbing speculation and focus on the quiet, incremental progress, or lack thereof, in its global operations and the ongoing struggle to turn its vast asset base into a reliable, cash-generating enterprise. The $10 target remains a distant possibility, not because of a lack of ambition, but because the foundational challenges of its business model are yet to be definitively resolved.